Thank you so much for having me, Matt. I really appreciate it. A bridge loan is a down payment loan. The majority of Americans have a good chunk of their wealth built up in the equity in their home. So a bridge loan is a way that lenders can access a portion of their equity to allow a client to put it as a down payment prior to selling their house. So if they're forced to buy a home before they sell their home, the bridge loan allows them to have a down payment coming from the equity in their home. The way that the bridge loan works is we pre-approve the client for a bridge loan and for the new home consecutively. So then the client stays in their home, comfy cozy, waiting for the perfect house to pop up. Once that house pops up, they're pre-approved with the bridge loan. We would write a non-contingent offer, meaning writing an offer upon their new home without having to sell their current home first. We would get them under contract on the new house, and then we would process their mortgage and the bridge loan at the same time and can close in as quick as 10 days doing that to be competitive in a multiple offer situation. A bridge loan should be considered or used when a client is interested in a home that has multiple people interested in that home. So when a contingent offer is not an option, and in the greater Denver metro area, contingencies are something that have been hard to get approved because there are so many buyers interested in each home. So sellers that have a house to sell are forced to write a non-contingent offer on the new house. And so the bridge loan provides the down payment for the person that's wanting to buy the new home. So it should be used for people that have a house to sell and a house to buy, but they have to buy before they sell. So it's basically a very short-term loan to help them buy before they sell. To my knowledge, there's only really one type of bridge loan. The terms of the bridge loan can vary from lender to lender or bank to bank. Our bridge loan is a very standard bridge loan where it's up to 12 months that we can lend people those bridge funds, although most of my clients don't even make one bridge payment because they sell their home and pay off the bridge before the first payment is due. There are alternatives to a bridge loan. So basically, when you need to buy your new house before you sell your old house and you need to come up with a down payment, there's a handful of ways to access that down payment. So a lot of my wealthier clients can do a margin loan against their assets. Some clients take out an equity line against their house. That's another option. You can get a gift from family. You can take a 401k loan. So basically, an alternative to a bridge is being able to borrow from an asset in a very short-term way. So that's the most predominant alternative to a bridge loan, is a short-term finance or gift from family. Our bridge loan costs $500 for every $100,000 borrowed. So our most standard bridge that we do is around $250,000. So basically it costs a total of $1,250 to utilize the bridge. So a home equity line of credit, or HELOC, is most appropriate for somebody that intends to take out money to buy a rental property or a second home, and they intend to stay in their current primary home, because when you apply for a HELOC, you are telling the bank or credit union that you're applying with that that is going to be your primary home. If your intention is to go buy a different primary home, a HELOC or home equity line of credit is not your best option. That's when the bridge loan comes into effect, because when you apply for the bridge loan, the bank or lender knows that that house that you're securitizing that bridge loan against is no longer going to be your primary home, and that you are going to be paying it off in the short term.